Dark clouds have been looming as Deutsche Bank staff are bracing themselves for one of the most severe job culls in banking since Lehman Brothers collapsed a decade ago, with the German Lenders Board set to approve plans to shed tens of thousands of people and more than 50 billion euros worth of assets. Deutsche's investment banking chief, Garth Ritchie, has gone from Deutsche Bank, and Christian Sieving's plan to make 15,000 to 20,000 job cuts across the bank looks increasingly like a done deal. On Sunday, the board seems likely to rubber stamp the proposed reorganization, which would see up to 50% of jobs in the corporate and investment bank disappear. On Monday, it will all begin. You could see Lehman-style scenes outside Deutsche Bank on Monday, said one recently ex-managing director from the German bank, referring to the staff who streamed out of Lehman with their possessions in boxes in 2008. It's very sad what's happening. Though news of Ritchie's departure was telegraphed well in advance, in fact he was widely expected to depart before Sieving unveiled his turnaround plan to the bank's board on Sunday. Deutsche Bank has been rocked by some unexpected news that could revive the sense of fear and panic that sent investors running for the exits back in 2016, when many believed a massive DOJ fine might sink the bank. Echoing a mini-bank run from late 2016, when hedge funds that cleared derivatives trades with the bank started withdrawing excess cash and positions held with the lender, Renaissance Technologies, the hedge fund giant that Deutsche Bank AG has counted as one of its largest clients, has been taking money out of its prime brokerage accounts with the German lender over the past few months, according to people familiar with the move. While Renaissance, the secret firm known for its unrivaled medallion fund, remains a major client of Deutsche Bank, it has been moving business to Barclays plc and Bank of America Corporation, relationships it started this year, and other banks, according to the people who asked not to be identified because the information isn't public. Representatives for Renaissance and Deutsche Bank declined to comment. Hedge funds have been migrating away from Deutsche Bank for years. According to people with knowledge of the matter, through the end of last year, revenue from executing trades and lending securities to hedge funds was down by more than 1/3 compared with 2015. Back in 2016, news of the hedge fund bank run sent Deutsche Bank short-term CDS soaring, though Friday's news hasn't had much of an impact on the cost to insure Deutsche Bank debt. That could soon change. With the head of his investment bank gone and pressure from departing clients mounting, CEO Sieving is expected to take direct responsibility for the unit as he helms what's expected to be a costly restructuring that could come with a €5 billion or $5.6 billion price tag and layoffs of some 20,000 or 1 in 6 employees across the bank. In fact, Sieving will run the investment bank despite coming from a retail banking background. According to eFinancialCareers.com, Ritchie, who earned €8.2 million last year, was tasked with refocusing the corporate and investment bank in 2018, but only achieved 80% of last year's targets. He's been widely rumored to be on his way out for months. The bank's board is widely expected to rubber stamp Sieving's plan, which could involve the shuttering or sale of the bank's U.S. equities business and other unprofitable or struggling business lines. Sieving's job cuts are expected to hit the investment bank particularly hard, with the expected elimination of up to 50% of jobs. Though some believe the job cuts will take place slowly over the course of the next year, one former MD told eFinancial Careers that mass firings could happen as soon as Monday, when Lehman-like crowds might form outside the bank's offices in London, New York City, and elsewhere. You could see Lehman-style scenes outside Deutsche Bank on Monday. It's very sad what's happening. According to the FT, Chief Regulatory Officer Sylvie Matherad is also set to leave the bank after presiding over an unceasing stream of embarrassing AML losses. In a farewell email obtained by eFinancial Careers, Ritchie said DB's corporate and investment bank had been his home for almost half my life and nearly all my working career. I have thoroughly enjoyed my time here, even the challenging moments, Ritchie said, adding that he has made many friends at the bank. To be sure, if Zieving's restructuring fails to right-size the struggling bank and clients continue to pull their money, the Lehman-style failure could follow in the not-too-distant future. So, how did Deutsche Bank, which at one time was among the top 5 prime brokers following the financial crisis, end up in a situation where the future of its prime brokerage business is in question? Let's take a look back at the key defining moments for Deutsche Bank's prime unit. April 2015. Co-head of Global Prime Finance Murray Roos leaves Deutsche Bank to take on global equities role at Citi. Deutsche Bank at the time said it was planning to reduce its balance sheet by €200 billion, of which 40 to 50 billion euro will be through client reduction. August 2015, Deutsche Bank's co-head of Global Prime Finance for North America, Scott Carter, departs to join hedge fund AQR Capital Management. September 2016, Bloomberg reports 10 hedge funds have moved to limit their exposure to Deutsche Bank and have withdrawn funds, fearing the bank could collapse under the weight of the potential $14 billion fine from the U.S. Department of Justice. Hedge funds that had pulled business include the $34 billion hedge fund Millennium Partners and the $14 billion Capula Investment Management, according to Bloomberg. October 2017, Marcello Pizzimbono, head of U.S. prime brokerage, joins Goldman Sachs for senior equity sales role. July 2017, Deutsche Bank cites prime finance as the major reason for a 28% decrease in equities revenue off the back of lower margins and lower client bases. However, it said client balances had returned to pre-September 2016 levels. April 2018, Deutsche Bank says it's considering making significant cuts to its U.S. prime finance business as part of a wider restructuring program to the investment banking unit. The plans include a significant reduction in headcount across the U.S. and Asia. May 2018, plans are revealed to reduce Deutsche Bank's leverage exposure in prime brokerage by around $50 billion, alongside 7,000 job cuts to the global equity sales and trading unit. September 2018, Greg Bunn, its global co-head of prime finance and 20-year Deutsche Bank veteran, departs. Matt Bowen and Angus Yang were appointed to co-run the business. Deutsche Bank spent much of 2018 pitching to its largest clients to be their top European prime broker rather than drum up new business. April 2019, merger talks with Commerzbank collapse, renewing pressures to make radical cuts to its U.S. investment banking business. May 2019, Reuters report Deutsche Bank's prime brokerage unit was highlighted as a key focus for cutbacks, as CEO Christian Zieving warned shareholders of a transformational phase to its investment banking division. According to a story published by Bloomberg, inside 60 Wall Street, the American headquarters of Deutsche Bank AG, the signs of trouble are everywhere. Begin on the 46th floor, overlooking the East River. Brown boxes have been stacked in the offices of the senior-most executive in the Americas. More than 40 flights down, on the trading floor, seats sit empty at mid-morning. Computer screens are black. Some who remain are openly hunting for jobs at rival banks. Their bosses know and don't mind. Several senior executives from the U.S. business have either already left or are planning on making their exit soon. These include Peter Selman, the executive who came out of retirement in 2017 to try and turn around Deutsche Bank's flagging U.S. equities business. One top executive said he hasn't been seen at work in weeks. Several senior traders have also decided to call it a day. Long-time traders like Brad Kurtzman, Craig Bench, and Powell Fraser have also left the bank, followed by dozens of second and third tier executives, many of whom can't find jobs elsewhere. Some U.S. managers said that for years they advised cutting some smaller pieces of the trading business to improve profitability. As they exit, they lament that senior executives didn't heed their counsel and now need the heavy axe. That's left Ashley Wilson, the co-head of equities trading in the Americas, as the most senior executive now effectively charged with reorganizing the unit, though we imagine that terrible responsibility might prompt him to start updating his resume if he hasn't already. In one respect, the situation at Deutsche Bank's American unit mirrors what's happening in Puerto Rico 2 years after Hurricane Maria. At this point, anybody with the means to leave has already left. And though Deutsche Bank managed to pass the Fed's stress test this year, that doesn't change the fact that now that the Commerzbank merger has fallen apart, Zieving has run out of excuses to try and protect his bank's unprofitable iBanking franchise. Now all that's left is to see whether the group will be culled, sold, or shut down in its entirety.